Bismillah ar-Rahman ar-Rahim. Good afternoon, my dear students. Today we are going to cover stock valuation. As you see, this chapter could be chapter 8, could be chapter 7, or chapter 9 in different textbooks, but we are dealing with one topic. This topic called stock and their valuation. When we talk about stocks, we are talking about mainly common stocks. We are not talking about preferred stocks. If you will look for any company, the company can issue stocks. This stocks, we have two types. First type, which we call it common stock, and the other one, which is preferred stock. This preferred stocks is not the general case of stocks. This is occasionally stocks. We issue these stocks for a certain purpose. If the company doesn't have the trust of the shareholders, and the shareholders, they don't trust the future of the company, in this case, we issue the preferred stocks for a certain period of time. This preferred stocks will give a preferred right for the shareholders, not the common rights for the shareholders, okay? And this preferred stock should be convertible. Convertible to what? Convertible to common stocks. At the time, the shareholders will gain the trust of the company. They will convert their preferred stocks into common stocks. Why? Because preferred stock is going to be restricted to preferred dividends, which is fixed dividends. We call preferred stock as a fixed income security. It's going to be restricted to a preferred dividends, specific dividends, say 10%, 20%, 10%, 12%, 13%, 14% of the bar value of the stock, but it will not go more than that. If the company is doing very well, there is no limit for the dividends of the common stock, so the return of common stocks will exceed the return of the preferred stocks. At that time, the preferred stockholders will prefer to convert into common stock. At that time, we get rid of these preferred stocks. So when you see preferred stocks in a balance sheet of any company for a long period of time, it means that the company wasn't doing that good over time. For this reason, this preferred stocks didn't convert it to the shareholders, the preferred shareholders didn't convert into common stocks over this time. So again, let's go back to our topic, stocks and their valuation. The stocks, we are talking here about common shareholders. Common shareholders, they have some legal rights in any corporation. This legal rights is about what? They are the true owners of the corporation. As we see here, they are the true owners of the corporation, and they have the right to run the company. They have the right to elect the board of directors. They have the right to be nominated to be part of the board of directors as a board director member, as a member in the board of directors. These shareholders, as I told you, to elect the firm directors, and they have the right to be nominated for the board of directors, to be a member of the board of directors, which we can be in the United States and as well as in a lot of countries. If you are controlling 7% of the outstanding shares, you have the right to be nominated for the board of directors. You have the right to sit there and to have the share in the board of directors. Definitely, a lot of people, a lot of strategic investors, they will run after this to get into this seat in the board of directors so they can act as insider. But to act as insider, getting benefit of being insider, this is going to put you under the law. Okay? You can be in jail. Because of what? Insider trading is not allowed. Insider information cannot be released, or you cannot get benefit out of insider information. Not the case like a lot of stock markets that they don't trade based on anything but insider information. But insider information and insider trading, this is illegal action, you can end up in jail. So here, the right to elect the firm board of directors and to elect the officers to manage the company. We have something we call it a general meeting of shareholders. At the general meeting of shareholders, which will be held at least once per year, these shareholders will take all of the decision to run the company. You have votes with the number of the shares that you have. So if you have 1,000 shares, you have 1,000 votes. If you have 100,000 shares, you have 100,000 votes. So each share has the right to vote. One vote per share. As I told you, shareholders, stockholders, common stockholders can appear in the annual meeting and vote in the person by typically the transfer. Yeah, they can appear in the general meeting and they can give the right to somebody else to appear instead of them and take the decision. Definitely they will do, but they will give him a proxy. This is what we call it, proxy. This document is given by a number of shareholders to a person that is going to go to the general meeting of the shareholders and vote on behalf of them for the decision that he took. Okay? This proxy is like power of attorney. You are giving the power of attorney to somebody to act on behalf of you, to do what, to vote. For what? For some decisions to be taken by the company in the general meeting of the shareholders. As a result of doing something like that, we can have something we call a proxy fight. This proxy fight is another group of people. They will try to get as much as votes to vote for a certain decision. Mostly, if a person will do that, the one who will do this proxy fight is the board of directors themselves. They will try to get as much as they can proxies from other shareholders to vote on behalf of them for the decision to be taken by the board of directors. This, sometimes they pay money for this proxies. Takeover, a company can be taken over by something we call it a hostile takeover. Hostile takeover, what does this mean? It means that the strategic investor will go into the stock exchange and will take over the company by doing what? By buying the majority of the shares, buying something like 50+% of outstanding shares. By holding more than 50% of the outstanding shares, he is in control of the company. This is what we call it hostile takeover. This takeover could be friendly takeover, could be hostile takeover, friendly takeover. This strategic investor or another company will sit on the table with the board of directors to negotiate the takeover of the company. And if they agreed on the takeover, the board of directors will go back to the shareholders in a general meeting for the shareholders and offer them this deal. We have a deal to take over the company, and this takeover will be for this price. Definitely, the price to be paid for this takeover is higher than the market price. So if that stock is traded in the market for $25, definitely you will pay a premium above this $25 to take over the company with friendly takeover as a result of negotiation with the board of directors and the approval of the shareholders. If this didn't go well, and this strategic investor still have strong interest in this company, this strategic investor will go to the stock market and start the fight in the stock market to collect as much as he can of the outstanding shares to take over the company. Sometimes we call it, he's going to offer them a tender offer. It's like we stop the company from being traded in the market, and he will offer us something like $30, $35 to take over the shares. If we accept it, it's going to be. If not, he will keep doing this, increasing the price. This is what we call a takeover. Takeover, the control will be taken by another party, person, strategic investor, or another company or competitor in the market. With the common shareholders, sometimes they have the concern, what if we bought these shares and we got into the board of directors, since we have something like 7% of the outstanding shares. We have 7% of the outstanding shares. One of the strategic investors, he is investing in the company for one thing. He wants to be part of the board of directors. He wants to be involved in the decisions of this company. So he did everything to receive something like 7% of the outstanding shares. So he has 7% of the outstanding shares of outstanding shares, which is equal, say, 100 million shares. So he has 7% multiplied by 100 million. So he has 7 million shares, which qualify him to be part of the board of directors. The company all of a sudden issued new shares equal another 100 million shares. In this case, number of outstanding shares will be equal 100 plus 100 is going to be 200 million shares. And his ownership percentage of ownership is going to be 7 million over 200 million equal 3.5%. So he is not qualified anymore to be part of the board of directors. He is going to lose his seat. For this reason, we tell, no, we are going to add some features, some provisions into the common shares. What we call it preemptive rights, or we call it defensive rights. This defensive rights will give this shareholder the right to participate in any new issues with the same percentage that he has. What does this mean? He will get out of this new shares, he is going to get 7%. So he will have extra 7 million shares. So his number of shares is going to be 7. Total number of shares by strategic investor, by this strategic investor, is going to be 7 million plus the other 7 million. The old 7 million plus the new 7 million, which is equal 14 million shares. This 14 million shares will get him into the same percentage of ownership. So percentage of ownership is going to be 14 millions divided by 200 millions equal 7%. So he's keeping the same percentage, same percentage of shares, which qualifies him to be member of the board of directors. So he will not lose this. What if the company issued new shares with a lower price? At the time he entered into the company, 7% of outstanding shares, 100 million shares, he got 7 million shares at, say, $30 per share. Now, the new shares to be issued, okay, new shares to be issued is going to be at $20. What will happen? He is going to lose the value of his shares. But if we will give him the other 7, because at the end the 30 will worth 20. If we'll give him the right to buy the new shares at 20, so he has 50% at 30 with $30, and the other 50%, the other 7% with $20 per share. So he will be on average buying the share or holding the share at $25 per share. For each dollar bought at $30, there is another share to be bought at $20 divided by 2. So on average, it's going to be $25 per share. Okay? So if the price went to 27, he can make money. But if we didn't give him shares at 20 and the price went to 27, he will not make any money because he bought the share at $30, not at $20. So we are doing what? We are keeping his wealth away from being diluted. Okay? This is the process of defensive rights or preemptive rights of the common shareholders. To do what? To keep the wealth of the shareholder and not to lose his control over the company. We have different types of common stocks. Although all of the common stocks in the market are the same, you feel that they are the same, but we have different classifications for the common stocks. We have something we call it classified stocks. This classified stocks is used to meet the special needs of the company. Maybe they don't have the right to vote. Maybe they have extra dividends. Like what? Like normal we give dividends. So they have dividends up to $2 per share, but they cannot get more than that. Okay? They are classified like that. Okay? They are receiving a fixed dividends. Or they don't have the right to vote in the general meeting of the shareholders. The other types, we call it the founders' shares. This is the shares to be obtained by the founders. Mostly the founders, they don't pay for the shares. They are the one who came with the idea. They are the one who did everything for the company to be at that level. So they are doing what we give them. What we give them, founder shares. Mostly founder shares counts for 7% and above of the shares of the company. And mostly they receive these shares for free. Okay, this is the founder shares. With the founder shares, sometimes they don't have the right to vote. Sometimes they don't have the right to sell the shares for a certain period of time. Because of what? Because we want to keep them in the company at the time the company becoming public, not to run out of the company and the company collapse after that. So we keep them in the company. They cannot sell the shares before something like 4 years or 8 years. Normally, they cannot sell these shares for one run of the what we call it, one period of the board of directors. Board of directors can have something like 4 years or 5 years, 3 years. It's according to the law of the company. So they have to stay for one administrative period for the board of directors, 3 years or 4 years, to make sure that the company will be on the right track, not to be deceived by them. They sold the company for us and we cannot make money out of the company. No, we keep them and they cannot sell their stocks for a certain period of time. So if they did something wrong with the valuation of the company and they deceived us in the initial public offering, they are going to pay the price. Sometimes we keep them for 4 years. Sometimes we keep them for 8 years. They cannot sell the shares before 8 years. Another new shares might be called Class A shares with voting restrictions. This is mostly Class A shares. This is the shares to be issued later on in secondary public offering. The first time for the shares to go to, for the company to go public, we call it initial public offering. After that, we increase capital to finance the expansion of the company. Because the company became very successful, we issue Class A shares. This Class A shares with less risk than the original shares. So we don't give them the right to run the company, but they will enjoy the right to receive the dividends as the rest of the shares. But they don't have the right to vote for the company. Okay. The market for common stocks, we have two markets. One we call it closely held, one closed market, and the other one open market. The closely held corporations, it means that the corporation is divided into shares, and these shares held by a certain number of shareholders, and this certain number of shareholders will trade the shares among each other. But nobody from the rest of the market, from the open market, can come into this closely held corporation and hold shares from this corporation. Only the people in this corporation, they can trade among each other. They can buy from each other. They can sell from each other. This corporation, mostly like a family business. Like big families, they have corporations, but they don't allow shareholders to come out of the family to participate in the profit of this company. A publicly owned corporation, this was closely held, privately held corporation, and now the owners decided to put it into the stock exchange. So they will do what? They will offer it for everybody to participate in this one. So they will list this company in the stock exchange. We call it listed firm. This publicly owned corporation, listed firm. Listed where? Listed in the stock exchange. And anybody can buy, anybody can sell these shares. If you want to buy, just go and place an order to buy. If you want to sell, just go and place an order to sell through your broker. You cannot do this by yourself. You have to do this through a brokerage house. You give him the order to sell number of shares for you at the best price, or to buy for you at the best price in the market at that day, using his experience to decide on behalf of you. Types of the stock market transactions, we have something we call it secondary market and a primary market. Actually, we cannot have an active primary market unless we have an active secondary market. And this is one of the problems of the Egyptian stock exchange. In the Egyptian stock exchange, the market is not active as before. Why? Because we don't have, or the primary market is not active as before. We don't see that much of newly listed companies in the Cairo Stock Exchange. Because of what? Because the secondary market is inactive. It's not active as before. If you look at Cairo Stock Exchange, the deals that we make per day now, it's less than something like 5% of whatever we used to make in 1996 up to 2006, 2007, before the collapse in 2008. Okay, so there is no active primary market without active secondary market. This is secondary market. This is the stock exchange, Cairo Stock Exchange, New York Stock Exchange, Copenhagen Stock Exchange, or like the Nasdaq, when you buy and sell over computerized network and to buy from anywhere all over the world. Primary market, this is the market for the company held by private. This is the primary market. This is the companies to be offered for the first time to the public. The company was owned by a group of investors or a family, and the family or group of investors decided to put this company into the market. This is in the primary market. After putting this in the primary market through initial public offering, this company will be in the secondary market and will be publicly offered. We call it what? We call it going public. Going public, what does this mean? When we have closely held corporation to be offered to the public, we transfer the ownership from a group of investors to the public. It's like what? This going public, like a lot of companies related to the government, what we call it, the publicly held, the privately held companies by the Egyptian government, governmental enterprises, this governmental enterprises to be offered to the public. So we say that this is going public, okay? This transfer of privately held corporation to be publicly held corporation, this is the only time that the corporation will touch the money. This is the first and the last time for the corporation to touch the money if the company will not issue new shares. This money is going to do what? This money is not going to be raised to do a new business. This money is going to be transferred from a set of investors, group of investors, to another group of investors, which are the original owners of these companies. So when you hear about that going public, this is to increase the capital of the company. This is not true at all. This is kind of transfer of ownership from group of investors and to another group of investors, okay? Going public from privately held corporation to publicly held corporation. What we'll do with this money? This money is going to be for the original owners of this corporation, and they will lose their control over the corporation, and the assets are getting out of the market, okay? But this is not going to be put in again in the corporation, unless the corporation will issue another set of shares later on, okay? Going public will not help the company to raise capital. Going public, it's about changing the type of the ownership from privately held corporation to publicly held corporation. What will happen? Set of investors will give their money to another set of investors, and the second set of investors, which are the original owners of this company, will take this money. Maybe they will start another business or enjoy their life with this money. But there's nothing called that we increase the capital by going public. The common stock valuation is about what? It's about to find the value of the shares of this company. We value a company. We value the shares of this company. We want to know how much to pay for these shares. And actually, we're not paying for a piece of paper or a promise. We are paying for the cash flows that we are going to receive out of investing our money in this corporation by buying the shares of this corporation at the time this corporation will go public. So we do what? We're not valuing anything but stream of cash flow, but the cash flow in this case we call it dividends. The dividends to be received over time. So the valuation here is about what? It's about to calculate the fair value, not the price. We're doing what? We're calculating the fair value, not the price of the stocks. And we compare this value with the price. The value is driven by the business. The price is driven by buy and sell in the market. If the price matching the value, it's a fairly priced, not fairly valued, it's a fairly priced. If the price is above the value, the price is 25, the value is 20, it's overpriced. The value is the basic. The price above the value, it's overpriced. If the price below the value, it's underpriced. The value 20 and the price is 18, this is underpriced. There is a huge difference between price and value. The value will remain. The price can go up or go down, but the value, it is the same. What do you think about the devaluations that happened to the Egyptian pound? Before the devaluation, any car in the market worth something like 250,000. After the devaluation, this car became not less than 600,000 Egyptian pound. What happened to the car? The value of the car increased? No, not at all. The car, it is the same. The car didn't change. The size, the car didn't change. The color, the car didn't change. The features, the only thing that changed is the price. The value is the same, but the price went up. After that, with the خليها تصدي, with a lot of other things, with the decrease in the interest rate and inflation and that, the price started to go down. Anything happened to the car? No. The value of the car increase or decrease? No. The whole thing is about what? The price. Price is about supply and demand. Value is driven by the business, dividends or earnings or whatever. So there is a lot of terms to be used for value. DT, this is the dividends to be received at the end of year one. Okay, D0, this is the dividends, the most recent dividends or last year's dividends. P0, this is the actual market price of the stock today. B hat T, we call it B hat T, this is the expected price of the stock one period from today. G is the growth rate of dividends, okay? And K, this is the required rate of return. And K hat, this is the expected rate of return of the stock. And this is the average rate of return of the stock, or sometimes we call it an actual or realized rate of return. Okay, so I'm sorry. Let me change something. This is V naught. This is not V naught. This is V naught. This is the value. Okay, this is the value. It's a common mistake in most of the textbooks that we calculate the price. We don't calculate the price. The price is a function of what? Price is a function of supply and demand. This is the law that we know from economics, and I think that you studied economics. And if you didn't study economics, definitely you are going through this now. There is a lot of demand, there is less supply for this alcohol, for this masks, and all of these things. What happened to the price? The price went up like crazy. Whatever we used to buy for something like 1 Egyptian pound, now we are paying something like 20 Egyptian pound, and we cannot find it. Alcohol, we used to pay something like 5 or 10% of whatever we pay now because of what? Supply and demand. There is a hell of demand, and there is not that much of supply. Price is a function of supply and demand. This is what we know. If supply greater than demand, price is going to be up. If supply less than demand, price is going to go down. If supply is equal demand, price will remain constant. That we know. This is what we know. What supply, what demand with the stocks? Supply of the stocks, this is the asking to sell. This is what we call ask to sell. And demand, this is bid to buy. You are bidding to buy. Here, asking to sell, bidding to buy. If the people asking to sell higher than bidding to buy, this supply, this is demand, I'm sorry, the price is going to be down. Here the price is going to go up. The people that are asking to sell more than the people that are bidding to buy, what will happen? The price will go down. The people asking to sell less than the people bidding to buy, the price is going to go up. Asking to sell, bidding to buy. Asking to sell more, the price is down. Asking to sell less, bidding to buy more, the price is going up. Asking to sell equal, bidding to buy, the price is going to be the same. Thanks God, I'm still remembering some of the economic laws. Okay, so what's going on here? This is the price. This is the price. And this price at time 0, it is published. We have nothing to do with. This what we call it a closing price. This is the closing price. Every single day the stock is going to be closed at a price. This is as a result of what? As a result of a lot of people bidding to buy, a lot of other people asking to sell, and this is the price at the end of the day. Okay? So here the P naught is coming from the market, but here what we are doing, we are calculating the value. Okay. We have different types, or we have different models to calculate the value of the stock. Dividends growth model, but what if we don't distribute any dividends? What if we don't distribute any dividends? We cannot price, we cannot value the stock? No. We go to the other method, cash flow method, the free cash flow method. Definitely the company has cash flow. Since the company exists in the business, the company is collecting and paying, and there is cash flow. So we can judge this cash flow. But sometimes the cash flow is negative. We went through this at the tough time of the, whatever you call it, revolution, 2010, 11, 13, 14. A lot of companies, they were running the company with negative cash flow. So the company is going to be with negative value? No. In this case, we go to the rest, to go to the last one, which using multiples. We use multiples to calculate the value of the stocks. We have an earning multiplier, we have an EBIT multiplier, we have an EBITDA multiplier, we have sales multiplier. Lucky you that we don't force you to study anything but to study dividends growth model and free cash flow method. Okay, this is the way to calculate. This is the way to calculate the value of the stock. It is nothing but discounting the expected dividends of this stock. We have one assumption. You see here dividends until perpetuity. What is this? We receive dividends until perpetuity? No. You will not receive dividends until perpetuity because at a certain point of time you will pass away. But the company will not pass away. The shares that you have are going to go to somebody else. So your blood people, your blood family will get this, will inherit these shares, and they will continue with the company, or they don't want the shares, they will sell these shares to somebody else who's going to carry their position in the company as shareholder. So again, we are doing what? We have something we call it in accounting ongoing concern. The ongoing concern, what does this mean? It means that the company will remain in business forever, but you can get out of this company by selling your shares to somebody else who's going to take your place. So you see, as we are discounting to perpetuity, okay, we are discounting until perpetuity. With this dividends, we have constant dividends. We have no problem with the constant dividends. But what if we don't have constant dividends? Stocks with non-constant dividends. In this case, we have to use something else to value these stocks. Okay? With a constant growth stock, we have something we call it normal growth, we have something we call it supernormal growth, and we have something we call it growth. This growth, the last one, which we call it the constant growth, is not going to be the constant growth of 10% or 20%. No. This is going to be the constant growth of the economy. Sometimes we use the growth rate of the GDP. We use the growth rate of the GDP to calculate. To calculate what? To calculate the value of the stock. Okay, so we have to get into a point where we have a constant growth. Okay, and this is the way to calculate the stock price. Okay, let's go through some numbers. Let's go through some numbers. Again. I'm sorry. This is V naught, not B naught. I changed this so many times, I don't know what is wrong with it. Every time It's coming back. I change and I forget to save. So let me save it. Continue. And that's it. Okay. So how to calculate it? How to calculate it? How to calculate the value of the stock? The value of the stock here with constant growth. We have three models. We have first model, means we call it one stage model. Second, two stages model. And the third one, three stages model. What is one stage, two stages, what three stages? For each one of them, a use. They are not used for all of the companies. They are used. This one stage model, this is, we call it constant growth. These two stages, it is normal growth followed by constant growth. Again, what does this mean? You will know now. This one is going to be super normal growth followed by normal growth followed by constant growth. Okay. This constant growth, this used for large cap. This large cap will go over time with constant growth. This is the growth rate of the economy. Okay? This large cap will go over time with the constant growth of the economy. Why we say that? Why there is no normal growth or supernormal growth with large cap? Because it's large cap has the highest market share. They cannot grow more than that. They are everywhere and anywhere. You find them in every single corner in the country. There is no any place else to open unless something happens with the economy. So again, we'll go to what? The growth rate of the economy. So this constant growth to be used for large cap. Normal growth. Normal growth, this is mid cap. Has to go at a normal growth to go to large cap. And at the time it's a large cap, we'll go to this one. We'll go with constant growth. So this is one stage. This one stage to go from mid cap, second stage, it will be large cap. And this one, supernormal growth, this is for small cap. Only small cap, they can grow at a supernormal growth because they are a new company to the market. There is no any competitor. They can grow as much as they want if they have the market or the wide acceptance of their products. So this small cap will go with supernormal growth. To where? To be mid cap. And mid cap, normal growth. And this mid cap will grow by constant growth. At the time it is large cap. This is what we have in business. It's nothing more or less than that. Small cap has to go up by supernormal growth. And at the time this small cap will go up by supernormal growth, will go immediately from small cap to mid cap. But when we see this company making that much of money, that much of profits, what will happen? A lot of competitors will come to the market to do what? To do the same business. So the supernormal growth will go down a little bit, and everybody will enjoy the normal growth. And after that, the company will go to large cap or will stay as mid cap. Okay? This is what we have in business. Mid cap to go to be large cap, a large cap will remain as large cap, or large cap will go out of business. This is the way. This is the 3 stages. Okay? 1 stage to be used with the large cap, 2 stages to be used with the mid cap, 3 stages to be used with the small cap. So say constant growth of the economy is something like 3%, this normal growth something like 10%, and this supernormal growth something like 30%. You can enjoy this normal growth for something like 2 years, and you can enjoy this supernormal growth for something like 3 years. So it's going to be, and this 3% is going to be constant growth forever. It's not going to be for any other time, but forever. We have to get into this constant growth to be able to value the company. We cannot value a company going with normal growth like this. No, it has to go to constant growth. We can have 0 growth, no problem. It's constant growth, but 0. So we are valuing what? We are valuing the company by discounting the cash flow related to this company, which is dividends. Okay. How to calculate it? We calculate this using perpetuity formula, the one that I explained to you with the time value of money. The perpetuity formula is saying what? V naught equal what? V naught equal BMT divided by interest rate or discount rate. Here we are going to replace what? We are going to replace BMT by dividends. We are going to receive dividends. This dividend is going to grow at constant growth of 1 plus growth rate. This growth rate could be 0. So dividends at time 0 is going to be dividends at time 1, is going to be dividends at time 2. Divided by what? Here we are not dividing by interest rate, we are dividing by the required rate of return. And we'll see how to calculate this required rate of return. L, rate of return of common stocks minus L growth rate. This is the formula to calculate the value of any stock listed in the stock exchange if this company is a large cap with constant growth. With constant growth. So we have to get into this. This is what we call it. This we call it perpetuity formula. Why perpetuity formula? As I told you, we have this ongoing concern that we consider this company will remain in business forever. Okay? Okay, let's go through some numbers. Assume beta equal 1.2, risk-free 7%, market return equal 12%. What is the required rate of return of this stock? The required rate of return, we use this, what we call the capital asset pricing model, using security market line. This is security market line. We use the security market line to calculate the required rate of return. How to calculate the required rate of return? The required rate of return is going to be calculated as you see. Risk-free plus beta multiplied by market return minus risk-free. This is the formula. Sometimes I like to rearrange this formula to be that way. We say that rate of return of common stocks equal, sometimes in another textbook is going to be RS. Or RCS. It's a notation. It is nothing but notation for required rate of return. So the required rate of return of stock equal what? Risk-free rate plus beta multiplied by market return minus risk-free. Okay? This is the formula. Beta is given. Risk-free, RF, this is what we call it risk-free. This is the one under the control of the government. This is the Federal Reserve or the central bank to decide what is the risk-free in the economy. Okay? And this risk-free is 2 parts. This risk-free, it's real risk-free plus inflation. For this reason, we tell this is a risky-free of default because the government will not default. This is risky-free of default, but it's not risky-free of inflation. The inflation can wipe the whole thing out. And beta, this is security measure of risk. Yet this one is published. Okay? I will not ask you to calculate it. If you will go to finance major, you will know how to calculate this one. RM, this is market return. Okay? RM, this is market return. RM minus RF, this is market risk premium. This is the market risk premium. As a result of what? You have a risky free. You will quit the risky free and invest in the market. At that time, you have to get a risky premium because the market risk is much more higher than the risky free. So you have to receive a premium. What about beta I multiplied by market return minus a risky free? This is the security risk. This is a security risk premium. As a result of what? As a result of quitting the whole market and investing in a single security. What do you think about this security risk premium? What do you think about the security risk premium? Can lead you to a return higher than the market, equal to the market, or lower to the market? It can lead you to any of them. Based on what? Based on beta I higher than beta market, or beta I equal to beta market, or beta I less than the beta market. The market is the safest one, or the market not the safest one. Let's say it another way. The market, this is the average risk. This is the average risk. When you drive your car on the highway, you find a restriction 100 kilometers per hour. 100 kilometers per hour. There is a lot of people driving 120, 110, and some other people driving 80 or 85 or 60. But on average, they are driving with 100 kilometers per hour. This is beta. So market beta all the time is equal 1. Market beta, beta market equal 1. So if beta I higher than 1, يبقى السكيورتي I risk higher than the market risk. So return of I has to be higher than the return of the market. The higher the risk, the higher the return. And if beta I equal 1, equal to the market return, so security I risk equal to the market risk. So a return of I equal in market return. No more or less than that. Fair enough. And if the security risk is less than the market risk, so security risk less than market risk, so you don't deserve same market return. You deserve what? You deserve a lower rate of return. This is the relationship that we know from the market. It's all the time like that. Anything away of this, it means what? Mispricing. Mispricing. If you found that security in the market traded at a higher rate of return than whatever it should be, it means there is mispricing. With the mispricing securities, we make a lot of money. We buy underpriced when the price is lower than the value. At the time the price will go up to match the value, we sell the security and make a capital gain. Or we sell overpriced securities and we wait until the value is down. We do what? We buy these securities again and we make a capital gain. Okay? So this is the situation that we are talking about. This is the required rate of return. This is the required rate of return. Time. There's another thing. There's another thing. There is required rate of return and there is expected rate of return. Okay, what is the expected rate of return? So this is what? This is required rate of return, reflecting the true relationship between the security risk and the market risk. This is to be driven by security market line, where we have beta here and we have return over here. The higher the risk, the higher the return. Okay? This is the required return. Okay, what is the story of the expected return? Expected return of a security, expected return, or equal R hat of security I equal what? Price at time t plus 1 minus el price today plus dividends at time t plus 1 divided by el price today. This is the price that you paid for the security today. Okay? And this is the expected dividends of the security 1 year from today. And this is the expected price of the security 1 year from today. Are you going to buy something without expectation over the price and the dividends and the cash flow? Do we do anything in this life without expectation? Everything is based on the expectation. You study expecting to pass. You study too hard expecting to get A. You study less expecting to get F. It's all about expectation. You take your car, you drive expecting to be in the university at the accurate time. Sometimes you come early, sometimes you come late. So it's also about expectation. We expect something, we receive something. The difference between them, this is what we call it risk or L variation. So say if the risk-free as here, risk-free, 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 risk-free is 7%. 7% plus 1.2. This is beta multiplied by 12% minus 7%. So this is going to be, as written here, is going to be 13%. If you look, 13% is higher than the 12%, which is the market return. Why? Because beta is greater than 1. This is the relationship we explained over here. I erase it, okay? Okay, let's look at it. Okay, you buy this stock. This stock today is offered for $25. But you are expecting that this stock is going to be for something like $27 minus 25. This is what we call it capital gain. And you will receive something like $3, $1. This is going to be 4 over 25, so it's going to be 16. $1 as cash difference. So it's going to be what? 4 over 25. So this is 16%. What do you think? The required 13%, expected 16%. Are you going to buy or not buy? You are going to be crazy. You are crazy if you will not buy. The expected 16%, the required 13%, you will make extra 3%. So you will make money. Make sure that this stock price will go up. Because of what? For the stock price to make 16%, it means that the stock is underpriced. If you run to buy this stock, you are not the only one who's going to buy this stock. A lot of people are going to buy this stock. So what will happen? Demand is going to be higher than supply. And the law will work again. The pricing will go. The price will go up. So the price will start to go up and up and up and up. Maybe we'll get into 27, maybe we'll get into 28, maybe we'll get into 30. So you will make what? You will make capital gain. So all the time we do what? We compare between the expected return and the required return. If expected return equal required return, we are at equilibrium. the value will be equal to the price. And there is no capital gain, there is no capital loss. But if expected higher than required, it means it's under price. If expected lower than required, it means overpriced. So here we have this relationship. We have this relationship. Here we'll put required return. Required return using capital asset pricing model. Required return using capital asset pricing model. Here, required return of security I, 13%. This is the required return when it go up or down. Expected return. For the same security, some investor will expect that the price will go up. Some other will expect that the price will go up, but not by that much. Okay? So expected return could be calculated as. Here is one equation. The other equation, Ri hat equal what? Equal the price today, dividends at time 1, plus growth rate. Okay? This is another calculation. Expected return of security I, expected dividends at time 1, divided by B0, plus growth rate. Can we expect all of this? We can expect all of that. I will show you now how to calculate this growth. And dividends at time 1 is nothing but dividends at time 0 multiplied by 1 plus growth rate. This growth, and B0 is given. B0 is given. We are not going to calculate B0. This growth is calculated as return on equity of 1 minus payout ratio. It is nothing but 1 minus payout ratio. Do we know the payout ratio? It's a dividends policy. The company knows how much we are going to distribute. And we know that this company is paying 40%, 60% of whatever net profit available for shareholders. So we know this. And we know the return on equity. Return on equity. If you don't know what is return on equity, we can calculate return on equity as net profit divided by equity. Net profit, we have net profit from the income statement. Equity, we have the equity from the balance sheet. So say that net profit equal 10 million. Equity equals something like 100 million. So return on equity equal 10%. Halas? Say that this 10% multiplied by 1 minus the company is distributing all the time 60%, keeping 40%. 60%, this is the payout ratio. So this is going to be 4%. So we have gross rate of 4%. We have required return on equity of 10%. Okay? And we know the B0 now. And we know dividends at time 0. So if dividends at time 0, you don't have to do anything but to go to the last year annual report. You will look at the last year annual report. You will know how much we distributed as cash dividends to the shareholders. Multiply this by 1 plus growth rate. What else do you want? So say that they distributed last year $2. And the growth rate equal 4%. Divided by B0, which is 25. That's the stock price today is $25 plus 4%. So it's going to be 8. I don't have my calculator. So this divided by 25, this is 8%, and this 4% divided by 25, 8%. So it's almost 8.5% plus 4%, so it's 12.5%. So this is our expectation of what? Of the return. 12.5, 12.5, 12.5%. So R hat less than required. So this is overpriced or underpriced. This is overpriced or under. The required rate of return is 13%, but the expected rate of return is 12.5. This is overpriced. What to do? Sell. What if this RI hat equal something like 13%? It is fairly priced. So what to do with this fairly priced? Hold. What if this RI hat equal 15%? This is under price. What to do? Buy. This is what we know. This is what we have in the market. This is our decisions that we take all the time. We are doing nothing but to calculate required rate of return with expected return, and we take our decision. We will know it's overpriced, underpriced, or fairly priced. Takes a decision overpriced, sell, underpriced, buy, fairly priced, hold. Hold what? Hold your position. If you have the stock, don't sell it because you will not make money. If you don't have the stock, don't buy it because you will not make money. It's hold your position. Okay, let's go through some problems and look at how to calculate the value of the stock at time 0 to be compared with the price of the stock at the time 0. As I told you, the value is going to be difference at time 0 multiplied by 1 plus gross rate divided by required rate of return minus a gross rate. So it's difference at time 1 divided by required rate of return minus a gross rate. And don't forget that this required rate of return, we calculate this required rate of return using capital asset pricing model. This required rate of return is going to be equal to what? Risk-free plus beta multiplied by market return minus risk-free, or risk-free plus security risk premium. Okay? This is the key. How did we calculate this growth rate? Growth rate equal return on equity multiplied by 1 minus a payout ratio. What is return on equity? Equal net profit divided by equity. What equity? Common equity, not preferred equity. We have all of this? Yes, we have all of that. So, yeah, we have some concerns. Sometimes the growth rate of the company is higher than the required rate of return. If the company has, as I told you, supernormal growth, definitely this supernormal growth is going to be higher than the required rate of return. The company is growing at 40% and the required rate of return is 12%. We cannot apply this formula. And if the company has a normal growth of something like 15% and the required rate of return is something like 10%, we cannot apply this formula. We can apply this formula only at the time the required rate of return is higher than the growth rate, which means what? At the time of the constant growth. At the time of the constant growth. The constant growth of the economy or the constant growth of the company, which is related to the economy one way or another, when the company would become a large cap. A large cap companies, we call them blue chip companies. These blue chip companies, this is the companies to form the economy. So the growth rate of the economy is function of the growth rate of these companies. So the growth rate of the economy is similar to the growth rate of this company or the other way around. So let's look at this. We have beta 1.2, 7% risk-free, 12% market return. We went through this before, but using security market line, we can calculate the required rate of return, which is 7% plus 1.2 multiplied by 12% minus 7%. So it's 7% plus 1.2 multiplied by 5% is 7% plus 6%. 7% plus 6%, this is the 13%. This is the 13%. This is the required rate of return. To be compared to what? To be compared to the expected rate of return. How to calculate the expected rate of return? As I showed before, we have expectation over the price or we have expectation over the difference of the company. We can apply one of these two formulas to calculate the expected rate of return. If the required rate of return, again and again and again and again, if the required rate of return higher than the expected rate of return, it means this is not a good buy. This is overpriced securities. And if the required rate of return higher than, if the required rate of return less than the expected rate of return, this is a good buy. This is underpriced securities. And if the required rate of return equals the expected rate of return, it means what? It's fairly priced. Don't do anything, don't buy, don't sell, hold your position. This is how to calculate. So if we have difference at time zero of $2, as here, we have difference of $2, required rate of return is 15%, gross rate of equals 6%. What is the stock value? What is the stock market value? This value should be like what? This 2.12, this is nothing but dividends at time 1 equal dividends at time 0 multiplied by 1 plus growth rate. Dividends at time 0 equal 2 plus multiplied by 1 plus 6%, which is the growth rate. So it is 2.12. This 2.12, which is here. 13%, we calculate this 13%, 6% it is given, but maybe I will give you some other information to calculate this growth rate. So it's 2.12% divided by 7%. This is the fair value of this stock, $30.29. If this security is traded in the market for something like $28, what to do? The true value of this stock, $30.29. Trade in the market for $28. What to do? Buy, definitely buy. Because of what? You are not the only one to discover that this security is underpriced. The value is 30, the price 27, it's underpriced. You're not the only one who will discover this. A lot of people will discover this with you, maybe at the same time. So the first runner is going to make the highest return. So if you will buy it at $27, this security has to go up to $30.29. At that time, sell the security and make $3.29 per share. Can you imagine if you have 1 million shares? How much are you going to make? How much? $3,770,000. This is not going to be over a long period of time. This is going to be over a short period of time, which we call it speculation. Speculation, or speculating that the price will go up. Based on what? Based on comparing the fundamental value, which is driven by this equation, with the technical value, which is driven by supply and demand in the market. Okay? All the time, stick to the fundamental value, because the stock price has to go to the fundamental value. If it's overpriced, it will go down. If it's underpriced, it will go up to reflect what? The true value of the stock. Get benefit out of what? Mispricing. Over a short period of time, you are a speculator. Over a long period of time, you are a strategic investor. This is your decision, to be a speculator or to be a strategic investor. Wealthy investors, they like to be strategic investors. And small investors, young investors like you, they like to be speculators. Because of what? Because they like to make a hell of money in a short period of time, but they can lose all of their money because of this speculation over a short period of time. So here, if it's above 30, don't touch. If you have it, sell it. You have the security. Say that the value is 30, traded in the market for 35, and you have the security, sell it. It cannot be better than that. Somebody is willing to buy something worth $30 for $35. Sell it. If you need it, go back and buy it again at $30. You will get into the same position again. Can you imagine? If you have 1 million shares, traded in the market for $35, and you know that the value is 30, you can make $5 million. Because you will start to sell, and when you will sell, the price will start to go down. To reflect what? To reflect the fair value, driven by fundamentals of the stock. At that time, go back to the market and buy your 1 million shares, but at $30.29, and be happy with the $4,710,000 that you made. Okay, let's go to another example. What is the stock market price or market value 1 year from now? It is nothing but you multiply by 1 plus growth rate. It is nothing but multiplying by 1 plus a growth rate. So it's going to be dividends 2 equal dividends 1 multiplied by 1 plus a growth rate. So it's as easy as that. What is the value 1 multiplied by 1 plus a growth rate? This is going to be value 2. You can do it like that, or you can do it like that. So the value 2 is going to value 1 equal value 0, okay? Multiplied by 1 plus gross rate. Value 0, it was 30.29, multiplied by 1 plus 6%, is going to be this $32.1. It's not more or less than that. Very easy, very simple, okay? Here again, value 1 equal value 0 multiplied by L graph rate. Okay. So what do you expect about the dividend yield and capital gain yield? Okay. We have to explain this. This is very nice. This is very nice. We have two things. We have something like, say, total yield equal capital gain yield plus dividend yield. What is this? Why do you like to make our life complicated? It's not like that at all. It's because if you as investor, some investors, they are looking for capital gain and they don't care about cash dividends yield. And some other investors, they care about cash dividends yield, they don't care about capital gain. And some other investors, they like to have a balance between capital gain and cash dividends yield. So what is the hell? The hell is about this. Total yield equal what? Equal price at time t plus 1 minus price at time t minus 1 at time t, plus dividends at time t plus 1 divided by price at time t. Capital gain yield, this part, which is price at time t plus 1 minus the price at time t divided by price at time t. What about this cash dividends? Cash dividends yield, this equal what? Equal dividends at time t plus 1 divided by the price at time t. Today price, which is the price at time 0. So we can say what? This time t. So this price, 1 period from now, minus the price today, divided by the price today, and this dividends 1 divided by B naught. We know this. We know this. We know the dividends 1 equal dividends 0 multiplied by 1 gross rate divided by B naught. We have B naught. We know this. This is the B naught. It's in the market. What is the expected price? We make our expectation. Some people expect it's going to be overpriced. Some other people will expect this underpriced. So what is the deal? There is no big deal. Some people will make money. Some other people will lose money. This is investment. It's not about anything but to make or lose money. No way that the whole investment is going to be about making money only. Yes, all of us will go to an investment to make money, but some of us will lose money, some others will make money, and the market will balance itself. Okay? So this is, say, the price is going to be 30.29 minus the price today, which is something like, say, this is 32.10 minus, this is what we calculate, 30.29 divided by 30.29. And this is the difference at time 1, which is equal to 2.12 divided by 30.29. This is going to be 7%, and this is equal 6%. So 7% plus 6%, this is the 13% that we're talking about. This is 6%, I'm sorry. And this is 7%. And this is going to be the 13% that we're talking about. This is the expected yield to be compared to the required yield. If the expected yield higher than the required yield, very good. We're expecting 13, required 10, be happy, go and buy. Expected 13, required 15, what is the hell? Why to buy? Sell. Expected 13, required 13, you are at equilibrium. Okay. So it can be like that. Stock A, stock B, stock C. Capital gain. dividends yield. Capital gain, 13%, dividends yield, 0. So total equal 13. Capital gain, 0. And dividends yield, 13, equal 13. Stock C, capital gain, 6%, dividends equal 7%, 13%. Which is better? If you look only at the total yield, all of them are the same. All of them will give you nothing but 13%. So you are indifferent? No. There is a huge difference between security A, B, and C. This one with capital gain, for some investors that they don't want to realize any cash dividends out of the stock at any time, not matching their preferences. They want to realize at the time they want to see this capital gain, but they don't want to receive any cash dividends. So this is almost for the wealthy investors, for the large cap when they invest in other companies. This is for young investors in age. And here, this is the old investor. This is the retired people. Retired people, he's retired, he's something like 75 or 78 years. And you are telling him, I will give you a capital gain after 10 years. He's not in life after 10 years. He's going to be in another business. Maybe he's in hellfire or in paradise. We don't know. But he would not tell you, okay, I can wait for something like 10 years to give me this 15% capital gain. No, I want cash. I want to survive this 10 years. So he is in need for cash dividends. So these older people, retired people, all of this pension funds, they go to this one. And here, this is a balance. Somebody mid-age, he wants to make capital gain. At the same time, he is in need for some cash, like your dad. He is in need for cash to pay for your tuition fees, but at the same time, he wants to make some saving for you. So he will go to this stock. This stock is going to give him capital gain. The stock price will go up over time. He got the stock for 30. At the time he will be graduated from the university, the stock is going to be for 50. He's going to make $20 per share. This is good. This is going to be your what? This is going to be your reward for being graduated from the university. But at the same time, he's in need for cash to pay for your tuition fees. So he will go to this stock. This stock is going to give him this capital gain. At the time he will be graduated, he will make this capital gain. At the same time, he is going to receive, or you are going to receive what? You are going to receive cash dividends, and this cash dividends to support your tuition fees. This is what we have in life. Different types of investors with different types of cash flow. We get into this calculation. Okay, we went through this. Value the stock with non-constant growth rate. This is what I told you. 2 stages, 3 stages. It can be supernormal growth followed by normal growth followed by constant growth. We are not going to go to 3 stages. The story of the 3 stages is the same story like 2 stages. But the story of the 2 stages and 3 stages is different than the story of the 1 stage. This is 1 stage. This is 1 stage. It's nothing but 1 stage for large cap. This is 2 stages for mid cap. This is going to be for mid cap. So here, what do we have? If we have supernormal growth of 30% for 3 years, then long run constant growth of 60%. What is the B naught or the B naught? I'm sorry. I will insist to change it all over. B naught, D naught, given that D naught equal $2 and required rate of return as 13%. Okay, let's go. So 3 years. I told you, you have to do what? You have to draw a timeline. Timeline. You put the time over the line and you put the cash flow under the line. Here is time 0. The difference at time 0 equal what? $2. This is going to be used for 1 time, just to calculate dividends at time 1, and dividends at time 2, and dividends at time 3, but no more than that. Here is 1, here is 2, here is 3. Growth year 1 equals 30%, the growth for year 2 equals 30%, and the growth for year 3 equals 30%, then followed by constant growth of 6%. So growth of 4 to infinity equals 6%. And this is year 1, this is year 2, this is year 3, and this is end of year 3, beginning of year 4. Dividends, we want to calculate what? We want to calculate dividends 1. Dividends 1 equal dividends 0 multiplied by 30% by, let's write it like this, by growth 1. So it is $2 multiplied by 1 plus 30% equal $2.6. And dividends 2 equal dividends 1 multiplied by 1 plus gross 2, which is 2.6 multiplied by 1 plus 30% equal. And dividends 3 equal dividends 2 multiplied by 1 plus gross 3 equal multiplied by 1 plus 30% equal. And dividends 4. Since we got into constant dividends, you don't go beyond that. So dividends 4 equal dividends 3 multiplied by 1 plus gross 4 equal 1 plus 6% equal. So what is this one? This is going to be 3.38. So 3.38 multiplied by this is going to give you 4.394. And this is 4.394 multiplied by 6%, 1 plus 6%, so this equals 4.658. Take this to the timeline. Take this to the timeline. So you expect to receive here 2.6. You expect to receive here 3.38, definitely dollars. Here 4.394 dollars. Here $4.658 dollars. What is the value of this stock? We value using the required rate of return. Okay. Can I erase this? Can I erase this? Okay, I will erase this. I am in need for this. Okay. It's a discounted cash flow. Here, this is to be discounted for 1 year. And this is to be discounted for 2 years. And this is to be discounted for 3 years. And this is perpetuity. Remember, we said what? V0 equal dividends 1 divided by required return minus gross rate. We don't have dividends 1 here. We have dividends 4. So if we will put dividends 4, required return minus gross rate is going to bring me to V3. So this is going to bring me here, not 2 times 0. Okay, not 2 times 0. How to calculate it? This is equal what? Equal 4.658 divided by required return, which is required return, which is 13%. 13% minus 6%, which is the gross rate. This is going to give me this value. Okay? So this to come here is going to be divided by 1 plus 13% to power 1. And this one to come here is going to be divided by 1 plus 13% to power 2. And this one to come over there is going to be divided by 1 plus 13% to power 3. Can you realize? Do you realize something? 1, 1, 2, 2, 3, 3. And this one is going to be, after discounting this is going to be 66.55. We have to bring this here as well. So this is going to be divided by 1 plus 13% to power 3, because this is going to be at time 3. It's going to be at time 3, value at time 3, at time 3, not at time 4. And we bring this here. The present value of this number, as we see here, I don't have to explain it, but خلاص, you see it here. Okay. So here, this 2.6 divided by 1 plus 13% to power 1 will give you this number. And this 3.38 divided by 1 plus 13% to power 2 will give you this number. And this, to be divided by 1 plus 13% to power 3, will give you this number. And this 66.55 divided by 1 plus 13% to power 3 will bring you here. Sum them up, this is the value of the stock. Sum them up, this is the value of the stock. So now you know that the value of this stock right now, today, should be $54.01 or 11 cents. Is this the end of the story? No. You compare to what? To the market price. The market price is how much? 60? If you have it, sell it. 50? If you don't have it, buy it. 54.11, do nothing. Hold your position. If you have it, don't sell it. You will not make money. If you don't have it, don't buy it. You will not make money. Okay? This is the rules of trading in the stock exchange. We don't deal with the fairly priced securities if we are speculators. But if we are strategic investors, we deal with the fairly priced securities. If you are a speculator, you deal with what? You deal with mispriced securities. They are overpriced or underpriced. Since they are mispriced, you can make money. Okay? With the underpriced securities, you make more money than overpriced securities. Here's another example. But here, what about the growth rate? Zero growth rate. Can happen? Yes, can happen. I am satisfied with my position in the market. I don't want to grow my business. I'm happy. A lot of investors like that, they are happy with the money that they are making. They don't want to be bigger than that. So the growth rate of the company equals zero. So dividends is going to be growing at zero. Or the company is growing, but the company decides to give constant dividends. We call it constant dividends policy. We are going to give you $2 per year. We are not going to grow this. And the 6% growth rate, after that, this is the growth rate of the economy. After that, but we're not going to distribute anything more than $2. So this is going to be the dividends at time 4, and you repeat the same story. Okay? So this is 2 is going to be divided by 1 plus 13% to power 1, 2 divided by 1 plus 13% to power 2, 2 divided by 1 plus 13% to power 3. This 2.12 divided by 13% minus 6% is going to be divided by 7% to power, and we'll bring it here. And after that, the 30.29 to be discounted by 13%, so to be divided by 1 plus 13% to power 3, and we'll bring there. And you sum them up, this is the value of this stock. This is the value of the stock, 25.72. Do you realize something? Do you realize something? This company, it is the same. Both of them, they started with $2. Both of them was required rate of return of 13%. Both of them, they will use the growth rate of the economy of 6%. But one, the difference has no growth, and one with this supernormal growth. So what is the difference? This is a growing company, and this is not a growing company. So the difference between this price, which is 54.11 cents, and this 25.72, okay, this is what? This is the price of the gross opportunity. This is what we call it, present value of gross opportunity. Present value of gross opportunity is equal 54.11 minus 25.72. Okay? So this is what we call it, present value of gross opportunity. Okay? It's going to be value of gross firm minus value of no gross firm. Value of gross firm, it was 54.11 minus the value of no gross firm, 25.7 something. $25.72. So it's going to be whatever. Okay? Okay. Another example and another example for this. Free cash flow method. Yes. This is the second method that we are using. Why we use this method? Why not dividends? Because sometimes our decision not to distribute dividends. Zero dividends. This is the required dividends by shareholders. They are not looking for any cash dividends. If we distribute cash dividends, they are going to sell our shares. They are restricting us from distributing any cash dividends. At that time, we will not be able to value the company. No, we value the company. But we don't value the dividends, we value the cash flow. There's no single company can live without cash flow. Cash in and cash out, and net cash flow. Okay? We use this cash flow. Which cash flow? We use the cash flow to firm. We use the cash flow to firm, or cash flow to equity. So this cash flow, we call it free operating cash flow. Free operating cash flow. To firm or to equity? To equity divided by required return minus gross rate. To firm divided by WACC minus growth rate. This is going to give me firm value. This is going to give me equity value. Equity value divided by number of outstanding shares will give me V naught. Here, this is firm value. This is not equity value. What to do? Minus total liabilities equal equity value divided by number of outstanding shares equal V naught. So we can calculate the value of the firm even if we don't have the cash dividends. Go after the cash flow. But take care. You are using which free operating cash flow? You are using the free cash flow to equity or free cash flow to firm? If free cash flow to firm, use WACC as discount rate. WACC, for now, will give you WACC. In Chapter 9, we are going to show you how to calculate the weighted average cost of capital. Okay? And we do it like that. To firm, divided by WACC minus the gross rate, will give me the firm value, but this firm value, not equity value. We are valuing what? Stocks. Stocks equal equity. So we take total liabilities out of the firm value. This is going to be equity value. Divided by number of outstanding shares, this is the value per share. If you have free cash flow to equity divided by required rate of return minus the growth rate. Again, required rate of return, risk-free plus beta multiplied by market return minus risk-free. Growth rate, we have the growth rate. Equity value will give me equity value divided by number of outstanding shares. It's going to give me value per share as equal. So let's go for this example. It's the same thing that I explained to you. We are going to calculate what? We are going to calculate L value, firm value, and we are going to calculate the value per share. Here is the free cash flow estimated for the next 3 years are minus 5 millions, 10 millions, and 20 millions, of which the free cash flow is expected to grow at 6%. The overall firm cost of capital is 10%. We don't have anything about liabilities. That means that we are talking about free cash flow to equity. Okay? Since we didn't mention anything about liabilities, this free cash flow to equity. Okay. Fine. Here is the required rate of return, and here is the cash flow. So we are calculating 5, 10, 20, and we are calculating the expected free cash flow to equity for year 4, which is going to be 20 millions multiplied by 1 plus 6% is going to give me 21.2. This is to be discounted for 1 period. So this is the value at time 3, not the value at time 0, which is 21.20 divided by 10% minus 6%, which is going to give me $530 million. We discount this at 10%, so it's going to give me 4.545, which is 5 million divided by 1 plus 10% to the power 1. This is 10 million divided by 1 plus 10% to the power 2. This is 20 divided by 10% to power 10% plus 1 to power 3. And this is divided by 1 plus 10% to power 3. It will give me all of this. You sum them up. This is the value of the equity. Divided by number of outstanding shares, okay? Divided by number of outstanding shares will give me the, say that we have something like 10 million shares. So per share is going to be 41.6. So what if this free cash flow to firm? Here we have the firm has 40 million in debt and has 10 million shares outstanding. What is the price per share? Value of equity is total value minus its value of debt, which is this number minus this number divided by, this is going to be 376,940,000, okay? Divided by number of shares, so the stock price is 37.69. Because of what we took this debt out of it, okay? As I told you before, if we have 10 million shares, this is going to be 41.6, okay? So this is how to calculate. Market equilibrium, when the market is at equilibrium, at the time that the required rate of return equals the expected rate of return. If required rate of return equals expected rate of return, the market at equilibrium. And the stock is fairly priced. This is the way to calculate expected return, and this is to calculate required rate of return. So if risk-free plus beta multiplied by market rate minus risk-free equal to difference at time 1 divided by B naught plus gross rate, it means that the market at equilibrium. But if they are not equal, it's one of two. The market is overpriced or underpriced. If it's overpriced, sell. If underpriced, buy. No more or less than that. We have something we call the efficient market hypothesis. This is very nice theoretical part of the chapter. We have three forms of efficiency: strong form of efficiency, semi-strong form of efficiency, and weak form of efficiency. It's about what? Some people, they tell the market is efficient if all of the publicly available information and private information reflected in the stock price. So strong efficiency will reflect all publicly available information and private information and insider information in the stock price, and the stock, nobody can make that much of profit out of the stock, okay? And the stock price is going to reflect all past, current, and future information about the stock. This is what? This strong form of efficiency. Some other people, they tell the strong form of efficiency about what? It's about not having that much of securities, mispriced securities in the market. If most of the securities in the market fairly priced, the market is strong form of efficiency. And you can go to semi-strong, and you can go for weak form efficiency. So strong form will reflect all of the information in the market, past, current, and expected, insider, private, and publicly, everything. Not that much of mispriced securities in the market. Semi-strong, all publicly available information will be reflected in the stock price. But what private? No. What about insider? No. What about future information? No. That much of mispriced security in the market, much more bigger. Weak form of efficiency, this is doesn't reflect anything but the past. Expecting that the past is going to be repeated, no sense. Doesn't reflect all the private information and insider information, only based on the public information, which is not fair. And a hail of mispriced securities. So what do you think about Cairo Stock Exchange? Strong form of efficiency, semi-strong of efficiency, or weak form of efficiency? You can decide. You can tell me. You can tell yourself. You can tell your dad. Our stock market is that form of efficiency. The last thing to be explained here, preferred stocks. Preferred stocks is not a common stock in the whole meaning of common stock. Common stock will take the risk. If we make money, they make money. If we lose money, they lose money with us. They lose money by the stock price will go down. But with this preferred stocks, no, it's a preferred stock. You receive preferred dividends. The company is making money. Not making money, you will receive this preferred dividends. If we don't have enough to pay you this preferred dividends, what will happen? This is going to be accumulated with the following year. If we don't have next year, it's going to be accumulated with the third year. If we don't have with the third year, we are going to liquidate the company. At the time we're going to liquidate the company, we'll do what? We will receive the par value that we paid for this preferred stock and unpaid dividends. With the common stocks, we don't have something like that. For this reason, we call it preferred stocks and preferred dividends. But they don't have the right to vote. They don't have the right to run the company. They don't have the right to participate in the huge amount of profit if the company is making a head of profit. They are restricted to the percentage of preferred dividends from the par value. Nothing more than that. Sometimes we issue these preferred stocks, as I told at the beginning of the explanation, with convertibility option. Some other time we issue them with call options that we can call it and retire them. Or we give you the right to convert it into common stocks if the common stocks making more better profit for you than preferred stock. Here is the example, very easy to value and price. Here, the expected return of preferred stocks was value of market price of $50 and annual dividends of 5. Dividends is going to be 5 multiplied by 100. This is the stock price, okay? So what is the expected return? It's going to be $5 divided by the market price, which is 50, so it's 10%. And we can flip it. If we want to know what is the value of the stocks that pay you $5, if market interest rate is 8%, so this is going to be 42.5, I think. Why to make it hard? Say this to $8 and this 8%, this is $100. What if interest rate went up to 10%? It's going to be $80. What if interest rate went down to 5%? It's going to be $160. So the value of this preferred stock is a function of what? Is a function of interest rate. If interest rate up, value down. If interest rate down, value is up for this security. Normally, the people that they don't like to take high risk, they go to preferred stocks. Thank you.